Ladies and gentlemen, boys and girls, a very warm welcome to this presentation at Inflo. I'm Manish Dhawan. Today we are going to talk about our offering Factor Edge. Who is it for? Who is it not for? What to expect? Uh, let's get disclaimers out of the way. Inflo is AMFI registered corporate mutual fund distributor. We do not charge anything to the clients. All our income comes from the AMCs. Now, before we talk about Factor Edge, it's very important that we educate the clients on what are factors. Factors cheese kya hai. So, initially so I'll be very honest, the mutual fund industry has woken up to the concept of factors rather late. It's only in the last couple of years that we've heard of terms like momentum, quality, value, low volatility. Prior to this, uh, majority of the play was on the flexi cap, where you trusting the mutual fund manager to deliver alpha. It was working fine, but before Spiva came along and clearly started showing uh, the writing on the wall, which was that mutual funds are not beating their benchmarks. So the benchmarks have improved, and now factors are there. What are factors? So, like for example, the ones I mentioned here, the couple of them, momentum and quality, the ones which we will be interested in. Momentum as a factor basically says जो ऊपर जा रहा है वो जाता रहता है. It's a documented alpha. So stocks that are already winners tend to keep winning. The mean reversion kicks in a lot later, but before that you get a chance to capture this alpha. The entire process of capturing this alpha is called momentum investing. Now mutual funds have whole lot of offerings in almost all the market cap segments for the momentum factor. Then there is this second factor called quality. You guys must be definitely aware of it. Warren Buffett has generated majority of his alpha uh, playing out this factor only, which is strong balance sheets, high ROE businesses, stable earnings when invested in tends to generate alpha in the long run, beating the market hollow. So then this in a nutshell is what factor investing is. Now, how do we come into this? So at Inflow, we have basically devised this very interesting strategy where the core idea is that the 70% of our funds would always be invested in two factors, which is momentum and quality. We have extensively backtested various factors, including low volatility and value, and we figured out that the combination of momentum and quality is the smoothest, and they basically complement each other very nicely. It's like a yin and yang. When the yin is not yinging, the yang is doing its thing and carrying the burden. So this basically becomes our growth engine, the 70% of the portfolio, which is invested in momentum and quality. So equally divided actually, 0.35 goes into momentum and 0.35 goes into quality. The remaining 30% stays invested in conservative debt. Now the kicker is that this debt component acts as a dry powder. We will utilize this 30% and systematically redeploy it into equity when the drawdown hits a preset levels, making this a very robust 70-30 model with a timing overlay where this 30% component, which is the conservative debt, will be redeployed into equity. Now we have hand-picked mutual funds for all the three, the momentum, the quality, and the conservative debt, keeping in mind all the checklist and parameters that we have to ensure that the fund house that we are selecting are the ones we trust. Now, why this matters? Now, imagine three equity curve, guys. First is your pure equity, which would be, let's say, if you would invested 50% in momentum factor and 50% in quality factor. It will have relatively brutal drawdowns. First of all, it will have lot lesser drawdowns compared to if you were only invested in quality or only invested in momentum. When you mix these two, the drawdowns come down. Having said that, even they are pretty brutal for majority of the investors. Then comes a static 70-30 model, where let's just say 70% is invested in the factors and 30% is invested in debt, which gives you a smoother equity curve. Now the problem with the second option is that it leaves returns on the table, because this 30% debt is always in the debt and is a lag on the performance, because typically debt funds would earn you what, 7-8% at max, right? Then comes the third factor H, which is our offering, which basically is adaptive, and it harvests the equity gains and redeploys them at a cheaper levels. Now how we are doing this is pretty fascinating. See, we've been in the market since 2011. We have run factor funds in momentum, and we also have Mystic Wealth Value, which was running. So we over these years have figured out that this preset points of drawdowns, where let's say our equity curve of a momentum or a value is at a preset drawdown, invariably market tends to bounce from these levels. So what we have done is that in this factor edge solution, we would be deploying this 30% debt back into equity on these specific preset drawdown thresholds. It is rule based, it has no emotions, so there is no human overlay per se. The system would decide when it has to bring in that debt into equity. And then later on, closer to the newer highs, we will redeploy the equity back into debt and turn it into a 70-30 model all over again. Doing this churn over and over again in, years out, generates approximately 2.5% CAGR alpha over and above the 70-30 model. Now, it definitely has a psychological edge, guys. See, most investors quit in panic. Factor edge is designed to become your core portfolio. You can have satellite portfolios outside. So let's just say we have sectoral thematic fund offerings which are selected based on our algorithm. They basically would generate alpha. Let's say they are the satellite offerings, and then we have a core offering, which is this factor edge, which you don't have to touch ever, and let the compounding journey continue for good decade or more. So it has a built-in buffer. The dry powder gets redeployed, and the overall equity curve is so smooth, the drawdowns are so less, it gives you the confidence to stay, making sure that this becomes your core portfolio. See, the entire concept of a core portfolio is कि आप उसको हाथ नहीं लगाओगे, that you will not touch it. You will let the compounding continue. That can only happen when the drawdown are within your pain threshold. And so that is what we are trying to achieve here. Doing a 70-30, creating a smoother equity curve, you stay put. And as far as the alpha is concerned, we try and generate that by our sector AI based selections, and those can include themes, countries, anything that the algorithm is picking. When you combine both together, you realize you're generating alpha while keeping in mind the downside, because that is very important. Nobody's talking about it. That's the elephant in the room. If the downside's not taken care of, you'll be thrown out of the train. We have to stay on the train to enjoy the compounding journey. Now, how do you access it? This is available via Inflo Mutual Fund distribution platform. Simply email us at info@inflowealth.com, and we'll carry the conversation forward. You can also visit our website, inflowealth.com, and click on the contact us page and drop in your details. Thanks for listening.